Hello, it's Ariel McKenzie, your Georgia realtor, and I'm back with another video for you. I wanted to make this video because a lot of people might think that buying a house with bad credit is impossible, and just with the right strategies, you'll be able to turn a no into a yes. So I want to make sure I make this video outlining those so that you know exactly how possible it can be, and then you won't have to constrain yourself to paying those high rents when you have great credit and you can buy a house. If you're a first-time homeowner, you can have a minimum credit score of 580, and that will actually get you a 3.5% down payment. You can actually also have as low as a 500 with FHA, but you'll have to put a 10% down payment. But don't worry, if you've owned a home before, but you haven't in the last 3 years, then you can be considered as a first-time home buyer again. If you have between a 600 and a 640, then there are many programs out there in your state, not just Georgia, because I know I'm a Georgia realtor, but even in Michigan, if you have a 640, then you can get down payment assistance. That will actually help you, and you will only have to bring 1% to the closing table. So if you're not quite there yet when it comes to your credit score, these are some things that can help. So first, you're gonna wanna make sure you look at your credit score and see what's on your credit hindering you. So everybody can get a free credit report each year from annualcreditreport.com, or my favorite that I actually would recommend is my FICO, because that will let you know exactly what your score is when it comes to the regular FICO score, a mortgage FICO score, and an auto FICO score. Once you look at your credit, you'll want to look at the discrepancies and the derogatory items. Then you'll want to dispute those for any inaccuracies. Just so you know, any medical collections are excluded from FHA. They're not even looked at, as well as any charge-offs that have aged 2 to 3 years are usually they don't hurt you as much as a new charge-off. However, there are recent charge-offs that either may have to be paid at closing or may not have to be paid at closing, but that's up for you and your lender to decide. A second tip would be to increase your down payment. If your credit score is in an area where you're not able to dispute any inaccuracies and get any derogatory accounts off the credit, then you might want to use money as your because money talk. You might want to use that as your superpower to go ahead and be able to get a house by doing a higher down payment, like 10%. So you want to look for a lender that's willing to work with you. I've had clients who were given a cold shoulder by some lenders because they're not willing to work with someone with less than perfect credit score, and they're not willing to help even though the deal can still be done. If you look for a lender that's willing to help you, they'll tell you what purchase price you need to be in, what taxes the house need to have, and those things, just by them telling you what range to stay in when looking for a house, can help you with your debt to income ratio, and that will be able to help you get the mortgage. Just so you know, like big banks like Bank of America, I know for a fact they have a lot of grants going on right now and down payment assistance. But if you have any derogatories on your account, they want it to be like nothing new within the last year and also paid. So you just want to look for more so credit unions, local banks, things like that. They're more flexible when it comes to your credit than big box banks like Wells Fargo, Navy Federal, Bank of America. When it comes to your debt to income ratio, as the last tip, you want to work on that and you want to improve it just so that you're fitting in the box for what they look for to qualify for the mortgage. So FHA, they can be flexible up to even 55%. I've seen clients go to in debt to income ratio. However, if you're doing any down payment assistance, they might want you to be lower, like 45%. But you want to make sure that anything that's fitting in your debt to income ratio, which would be anything on your credit report, so car loans, student loans, credit cards that are due, you want to make sure if it's a credit card, you bring your utilization down so that you're at the most smallest payment it can be, so that when it's counted towards your debt to income ratio, that payment won't really hinder you. As far as auto loans, you want to make sure that if you're able to get your payment down, speak with your loan provider, or if not, you can even refinance before you start trying to get a mortgage to get that payment down, because that will also count towards your debt to income ratio. If you have student loans and they're in deferment, just know that it'll count towards your debt to income ratio, because it'll count 0.5% of the total loan balance. So if you can get a student loan payment and you can do like 100, so that would be way better than having 0.5% of your total student loan balance. Because say for instance, if you have 30,000 in student loans, that 0.5% might be higher than that small payment that you can make. Basically though, it all boils down to the lender that you use, because it's up to them what they accept and what they don't accept when it comes to the underwriting process. Like, you'll want to find and shop around for a lender that's going to help you. And I know people might say, oh, if you get too many inquiries, it'll bring your credit score down, but it's temporarily. And secondly, they count as a package because the credit bureaus know that you're shopping. So if you are looking for a lender that will work with you, you just want to make sure you're talking to them. Just tell them your scenario before they even try to pull your credit, and see if maybe they can do a soft pull, because I've seen some lenders able to do a soft pull first as well, just to see what kind of position you're in before they do a hard pull. Also, when it comes to the bad credit, I know it's some people who might say, for instance, their Equifax is perfect, because that's my experience, but the other two might be not so good. Even though a mortgage lender has to pull all 3 credit files, they might not do a tri-merge credit file. They might just go with the highest score. And if your Equifax has nothing and that's your highest score, then you in there. So say for instance, if you have a different range of scores between TransUnion, Equifax, and Experian, and say for instance, if Equifax is your middle score and it has no derogatory account, and you might find a lender who just goes with the middle score. But if you find a lender who does a tri-merge file where no matter what your middle score is, they still look at all 3 credit bureaus and the derogatory accounts that are on those, then you want to make sure the lender that you're working with, even though every credit bureau has to be pulled when it comes to a mortgage, they use all 3. It just depends on what that lender will accept. So if you can find a lender willing to work with you, get the job done, do their job, because they do get paid for when you close. Make sure you're finding a lender who's on your side. There's a lot of lenders who want to give the cold shoulder because you don't have the 750 credit score that they're looking for, but that's not everybody. It's not all cookie cutter, but it can be possible for you. So that's my tips and tricks on buying a house with bad credit. If you want to hear more videos like this, make sure you like, comment, subscribe, hit that notification bell, and make the sale with Ariel.